Kia ora, ngā mihi nui ki koutou, and raurangatira mā nau mai, haere mai, whakatau mai, ki tēnei hui mariko. Ko Barry Coates aho, ko te kārahi o te patea whaiwhakaro. Nā reira, tēnā koutou, tēnā tātou koutou. Tihe Māori ora. So a very warm welcome to you all. I'm Barry Coates. I'm CEO of Mindful Money. And this is, if I've counted right, the 14th seminar in this series. These seminars are held on Wednesdays at 12:15. And all the videos and podcasts of the previous seminars are available on Mindful Money's website, on YouTube, and other good websites. So for today's session, we're celebrating two of the winners of Mindful Money's New Zealand Ethical and Impact Investing Awards. So these awards were established as a way to encourage the raising of standards for ethical investing and celebrating best practice. So as you may know, ethical investing is also known as responsible investing or social investing, green investing. And as you can tell from these proliferation of different labels, there's sometimes disagreement over what can be defined as good practice. So I thought it'd be useful just to run through the criteria. The judges looked at 4 factors in the evaluation of the entrance to the awards. Avoiding harm, so to see the investment fund avoid funding companies that do harm. Engaging with companies to improve their social and environmental standards. Investing in the companies that create positive impacts in the world. And finally, walking the talk in terms of a commitment to ethical and sustainable practices throughout their funds and their business. So in order to assess these standards, we had a panel of judges, and they're on our website if you're interested. And those 28 judges, kind of high expertise and independent. So now in the 3rd year of the awards, these annual awards have gained credibility for the seriousness and the rigor of that judging process, and they've become recognised as the standard for ethical investing in New Zealand. So the winners that we're talking to shortly are those who really do stand out in terms of their approach and their practices. Before we start, I should let you know that we're talking about some specific funds and specific providers during the seminar. The seminar's about the investment strategy, about the awards, about the practices, but it's not constituting financial advice for any individual, and it's not a recommendation for any specific fund or in fact any fund financial advisor. So with that caveat, let me start off by introducing the first of our winners. It's Temuera Hall. Tēnā koe, Tim.
Kia ora, Barry. He mihi kia koe.
Ngā mihi nui. Tim is co-founder and managing director of TAHITO, the world's first indigenous ethical investment service company. He works in partnership, TAHITO works in partnership with JMI Wealth, Clarity Funds Management, and Devon Funds as a group. And TAHITO's funds, or fund at the moment, combines indigenous values with ESG measures, as well as, of course, conventional markets expertise to provide unique and highly ethical and sustainable solutions. So, Tim, can you give us, as a starting point, your background and where TAHITO came from?
No, he mihi hoki kia koutou e whakarongo ana ki tēnei pūkōrero. No te aroa waka ahau, mai make tū ki Tongariro ko Ngāti Tūwhare tō te iwi. So, born in Rotorua, but completed my sort of formative schooling years in Taupo before attending Waikato University, and then, of course, did the obligatory OE. And when I come home, Barry, I started working for one of our large tūwharetoa o whenua trusts called Lake Taupo Forest Trust. And then over a sort of 30-year period, it progressed from trust and asset management into financial management, investment and financial services, and then took on various governance roles. And in the mix, got married and had 4 kids, and then ended up in Auckland. And that was in 2015. We moved to Auckland to support my wife's career, actually. And then by chance, I bumped into Paul Glass and Andrew Callagher from the Investment Services Group. And we talked about opportunities, work opportunities with them. And at this time, I was really only keen on doing Māori kaupapa-based sort of roles or projects. So to cut the long story short, we agreed to a partnership to develop an indigenous Māori ethical and sustainable fund. And in 2019, TAHITO was born. And then we launched our same year, we launched our first product, Te Tai Rehua Trans-Tasman Equity Fund.
So that's very recent, Tim, 2019. Congratulations for moving quickly to set up the fund, get capital into it, set up a track record. That's rapid progress. Can you tell us, sort of setting up the first fund to integrate Māori values, what are some of the challenges you're faced?
Well, building credibility and trust in the financial investment world is essential, and that takes time. Yeah. And then when you have a fund that's a little bit different, it brings in the words ethical, sustainable, and then indigenous, obviously throws up more questions and doubts. So that's the sort of the first hurdle. But then in our first year, COVID hit. So that brought about significant uncertainty and volatility in the markets. We only just launched. And but the biggest challenge was winning trust and support and bringing funds on board. But we're almost there now. I suppose then it's the ongoing and increasing compliance, disclosures, validation, and costs that comes with the labels of being ethical and sustainable in a financial product. We have to demonstrate where and how and why we're responsible, and where funds that seek financial returns only have to, they don't have to arguably just say that they are irresponsible by investing in businesses that have a negative impact on the environment or the communities.
Yeah.
They don't have to explain themselves, but we have to go to some length to do so. But that's changing. We've seen now in the EU at the financial disclosure requirements up there, sustainable financial disclosure requirements, that's coming, where you have to be honest and disclose on both sides.
Yeah, it's interesting, isn't it? It's going to affect virtually all investment providers, not just those with a strong set of ethical and sustainable principles. Tim, when people look at this, they often say, well, it's fine in theory. How do you do it in practice? And I know you've got kind of a well articulated framework, but can you kind of summarize how you build in Te Māori principles into your investment decision making?
Yeah, good question. Firstly, we had to establish our whakapapa and, so our own genealogical connection. And this is not about human genealogy. This is the bigger relationship, a connection to the environment, our creation narrative from our traditional knowledge. And we call that Te TAHITO, and hence the name of the company. And as you said, it's largely mapped up on our website and in our key policies. But the values we come up with, for the couple of examples, whanaungatanga tō ao, that's about relational collective reality, and that's understanding all relationships in an unconnected world, internal, external, commercial, social, environmental, and cultural, for example. Then there's whakapapa tō mana, independent collective identity, understanding that the business is interdependent, the roles rely on the total environment to succeed, and you're serious about ethics. So now you're into the care for people, care for the environment. And if you care for them, they'll care for you. It's a reciprocal aspect. A couple more examples, because there's a number of them, but hono tahi tō wairua, complementary collective self. So that's your competitive forces are dealt with in a complementary manner, not a negative, aggressive type manner. That brings in your core principles and values that extend beyond physical and material gain, effectively. Then Kawato Ora is another one, which is about cyclical collective success. So now you're going beyond financial and you're celebrating and encouraging successful behaviours and long-term sustainability. So we translate these values into applied statements and then develop measures to best reflect these. And in this same time, we come acquainted with environmental, social and governance data technology systems. And so then we aligned quantitative ESG data with our values. And then we developed a set of qualitative measures that reflect our values. And these, we find the answers for those through direct research. This all come together and we developed this process called te kōwhiringa tapu, which sounds flash, but it literally means careful selection. And in there, we've sort of developed our other flash words, sort of proprietary taxonomy. And so we ended up with about 60 measures, which develops what we call a TAHITO score. We look at far more information. We only use 60 measures for the score. And then we found out, well, that's actually called an advanced positive scoring system as opposed to simple negative exclusions. So now we're being labelled. And, that's sort of how it comes together. Once we've got our TAHITO score, that provides us with a short list of companies which are of adequate, ethical and sustainable measures that can fit into the portfolio. Then the rest is valuation, portfolio construction. Our investment committee has all the oversight, all your other standard product management and oversight.
Tim, that's great to hear. As you know, there's kind of huge international debate around some of the measurement of these criteria, environment, social governance, or ESG criteria, and you go well beyond that. What do you think of the ESG criteria in terms of the kind of framework that you've put in place? Do you find that they tend to be a distraction, or do you find them useful? How do those measures fit into your much broader quantitative and qualitative measures?
Well, I think ESG, and from when we started till now, the ESG space has grown significantly. I naively, when I first looked up, because we use ESG on from a factor level. So we're not looking at whether it's just got a triple A or A, or that high level, or the pillar scores or the theme scores. We're going right down and we're selecting the data sets that they use that creates those high level scores. And when I first started looking at it, there was big blanks. There was big blanks across the thing. So I naively rang them up. We use the MSCI ESG system. So I rang up MSCI and says, why is there blanks everywhere? And that's because most companies just didn't have that data. Now, a few years on, we're talking probably 5 years on from when we first started looking at this, most of those blanks are filled in key areas, like scope 3 emissions, for example. There was next to nothing. Now, just about every good company will have either an estimated or a reported scope 3. And so it's come a long way. The good companies have embraced it. As you know, they'll have a sustainability report or an integrated annual report, and there's as much effort that goes into their non-financial ESG data that goes into their financial data nowadays. And I'm pretty sure the big accounting firms are all geared up and probably make as much revenue now from their non-financial parts of their business.
Yeah. Hey Tim, just one more question to close off before we invite John on. Looking back over the 4 years or so since the start of TAHITO, what's pleased you most? What are you most proud of?
Well, firstly, you've got to acknowledge the trust, faith, and support from the investment services group, which they provide all the services and functions that allow us to operate in the financial markets. Then, of course, having a great team, support of whānau and friends, very important in any business. But as you mentioned earlier, our front-facing team, JMI Advisors, Select Wealth, they've been critical in our success in bringing clients and fund on board. And then having Sharesies and Invest Now, being on their platforms and, like being assessed through Mindful Money, that all adds to our journey and again, the credibility and trust we have to build. But of course, you're not a business without clients and their continued support. One thing we're quite proud of is that since inception now, we've provided annualized return of 9.6% after fees for the last 3 years, 1% over the index. And then this year to date, we're at 8.8% over the index of 5.1. So maintaining a high ethical standard while providing above market returns that's like a little bit of cream, because we're just out there to match the market and still remain ethical and sustainable. But what we're currently most proud of, Barry, is winning the Mindful Money Best Ethical Retail Provider Award for 2023. I think it's very uplifting for us.
Very cool, Tim. That was not a planted question, by the way, but but that's great, and you're a very well deserved winner of the award. I'm absolutely thrilled that you guys have won it, and the judges came to the right answer. Let me introduce John, and we'll come back to open up discussions with you in a little while, Tim. So. A very warm welcome to John Berry.
Kia ora, Barry. Thanks for including me today.
Of course, John. We couldn't leave you out. So John Berry is CEO and a great title, Resident Wayfinder. I want to be one of those one day for Pathfinder Asset Management. Before co-founding Pathfinder in 2009. John's been a lawyer and investment banker in Auckland, London, and Sydney. He's now an independent director of Punakaiki Fund, a member of the government working group overseeing the Code of Conduct for Financial Services, and he's a trustee of Men's Health Trust New Zealand. So very warm welcome, John, and congratulations on Pathfinder again. Winning awards in these Mindful Money Awards.
Cool, thank you, Barry. It was an honour to win the awards. Thank you,
John. Most people will have an idea of the story of Pathfinder, but can you kind of run through a little bit of where this all came from and what the impetus was for you and Paul Brownsey to found Pathfinder?
Cool, thanks. So we set up Pathfinder. Paul and I set up Pathfinder in 2009, and we were just set up as a normal fund management business to make great returns for investors. And I think the light bulb moment for us was really in 2010, so the following year, when we suddenly understood that the way you invest has real impacts on the world. So I think everyone understands how you spend your time, mentoring young people, volunteering your time has an impact on communities, how you spend your money through conscious consumerism, but how you invest your money is actually just as important as how you spend your time or spend your money. And that led us to launch the Global Water Fund in 2010. So our focus there was investing in companies that are providing solutions to the growing global water crisis. And that's around climate change, that's around water purification, treatment, distribution. Got to say, pretty hard going in the early years. A lot of financial advisors openly said to us that our fund was just for nutcase greenies and tree huggers, and it wasn't, it absolutely wasn't mainstream. But we kept on innovating, kept on introducing new products, and essentially our mission as a business is built around duality, and duality is individual wealth and collective well-being. So making money, but at the same time as making as much money as we can for our investors, just doing it in a way that's positive for planet and people. And we since launched our KiwiSaver 2019, which is a big moment for us, and then culminating in a few wins in your awards last week, Barry, which was great news for Pathfinder, and great testament to the investors of, like Tim was saying, you don't have a business without investors, retail and wholesale investors who believe in what you're doing, and we've got people joining us, we've got people that believe in us, and it's wonderful.
That's kind of interesting, John, because starting in 2009, it was 2019 that you launched the KiwiSaver. So that's a solid decade of work on kind of establishing and marketing investment funds before you entered the KiwiSaver space. That must have been a kind of quite a sort of a gradual development, because it's been kind of really quite explosive growth since then, hasn't it?
Yeah, look, to be honest, it was the first decade was actually quite hard going. And
Yeah.
I think, what was transformational for us as well was taking Alvarium on as a shareholder and giving us the capital to expand. The challenge we faced from when we launched for a number of years was just this ingrained belief that you can't be ethical and make money at the same time. And I think that that belief is not any challenge. That belief is now pretty firmly set to one side, that people accept you can invest ethically and make money. So that was one challenge we had to overcome. Another was really just for our business and our ideas and our insights, just getting oxygen and getting, we didn't have a big marketing budget, just getting our message out there. And if you go back to sort of 2016, you think of when people found out in their KiwiSaver they had landmines and nukes and a whole bunch of nasty stuff. The conversation started and stopped then with, what do I want to exclude from my KiwiSaver? And where we were actually taking the conversation, taking our investing was, yes, it's important to exclude stuff, but it's what you actually choose to invest in that's way, way more important. And, back then we actually, we got Ngāi Tahu on as a client, which was our first really large institutional client. And that was a game changer for us, but they just recognised instead of being a fund manager that thought 1, 2, 3 years ahead, we were thinking decades ahead. And it's really that longer time horizon. Suddenly there's a whole range of factors and risks that you have to take into account when you take that sort of intergenerational view.
Yeah. It's really good. Let's come back to one or two of those issues. But you mentioned the sort of light bulb moment for many people of realizing that you could actually make good returns as well as ethical performance. Do you just want to kind of run through the data from Pathfinder on that?
Yeah, absolutely. The really exciting thing for us when we talk about individual wealth and collective wellbeing, on the individual wealth side, since we launched our KiwiSaver in July 2019, from launch, we are the number one growth, balanced and conservative funds in terms of return. And I'm talking about data up to 31 May this year. I absolutely want us to always be above average, ideally top quartile. It's wonderful we're number one, but I just want to prove to people, which means we've got to stay above average. I want to prove to people that investing ethically doesn't cost. In fact, we'd say, and Tim talked about ESG and the way TAHITO invests, and we'd say that companies that care about ethics, companies that are high on ESG factors, companies that are looking for global solutions, they tend to be really high quality companies, and we believe they will generate better long-term returns because they have high quality management, high quality governance, and a stronger long-term business model, a more resilient business model.
Yeah. On Mindful Money website, we've got a page looking at where's the evidence for this? Where's the evidence that ethical funds have a good financial return? And, in addition to anecdotes, kind of Pathfinder, TAHITO, there's many others, not only from Australasia, but also around the world, and kind of big studies. And the evidence is pretty compelling now that, as you say, investing in good companies means investing in companies that take sustainability seriously, treat their employees well, avoid environmental liabilities, a whole lot of different factors. And typically, kind of from the financial perspective, they're undervalued by the market for those attributes. So I think that sort of evidence around does ethical investment pay is a really important factor for people who may be interested in ethical standards, but also want good financial returns.
Yeah, and look, I think a lot of the messaging around investment in New Zealand has been just focus on fees, get the cheapest you can. Yes, you can get cheap passive strategies that will invest in thousands and thousands of companies, and the management fees are cheaper. I'd say two things to investors. One is, our KiwiSaver, for example, we focus on 150 to 200 companies, so really hand-picked, not thousands and thousands, but 150 to 200, so much more targeted. And it's actually returns after fees that are really important for investors, and that's what investors should focus on. It's not about getting the budget cut price cheapest fee. We charge the average fee for active managers. We've set our fee at that level. It's not the cheapest in the market, but our after fee returns are great.
Yeah, we can come back to some of those issues. Just to conclude, John, what are you sort of been most proud of? What's kind of the you don't have to say the Mindful Money Award, but what's kind of given you the most satisfaction during the journey with Pathfinder?
Look, there's a number of things, and you say don't mention the Mindful Money Award, but winning most ethical KiwiSaver third year in a row was a really proud moment. I mentioned earlier about the duality of individual wealth and collective well-being, and if we think about with our KiwiSaver, I think the pride really comes from two things. One is the individual wealth side, the fantastic returns that our investment team is generating, and on the collective well-being side, sort of taking a step back, you mentioned at the start, I've been on the board of Men's Health Trust for a decade, and we struggle for long-term funding, and most great charities in New Zealand do, and I wanted to be part of the solution around that. So we want to provide long-term sustainable income streams to charities, impactful charities, and we do that by setting our KiwiSaver fee at the average in the market, the average active fee, and then giving 20% to charity. So far, since we launched our KiwiSaver in 2019, we've paid 850,000 to charities, and with what's accrued at the moment to be paid out, we're around $1 million. And I think for me, there's a massive sense of pride in not just generating great returns, but also providing our 18 charity partners with this fantastic long-term income stream that they can rely on year into the future.
That's great. Very good. So let's invite Tim back in, and we'll tackle some of the difficult issues. Great. So for both of you, there's a lot of headwinds out there. There's kind of financial volatility. There's climate change, which is starting to bite in a way that has really serious implications, not only for people's well-being, but for the economy. There's all sorts of ramifications from the Russian invasion of Ukraine and global instability. As an investment manager and with your particular lens around Māori investing and ethical investing, what keeps you awake at night out of these trends? How do you see things evolving on some of these issues?
Shall I jump in first?
Tim,
John?
Tim, you go first.
The Māori world view is quite a bit different, and we've been interestingly in participating in certain conferences and events, being forced to ask the question of where does the Māori system and the Māori value base sit within capitalism and the capitalist structure, and so in working through that, that's helped my mind figure out how this thing moves forward. At the end of the day, society doesn't change rapidly, but I think we're at a time where we do need transformative change, not incremental change. And unfortunately, all I'm seeing out of Wellington is incremental change, and that we're not going to achieve these targets. So, that's one thing that keeps me up. Then the second one is I'm starting to do quite a bit of work around the core natural resources that are required to sustain growth. Without getting hung up in the definition of growth, because that's a big, we always throw that challenge up, GDP, the amount of GDP that's actually negative on environment, society. So if we're going to still stay under that system and change, how quickly and what is the ability to switch out of oil and gas and coal, for example. But it's more those fine minerals that are needed to produce the new technologies, and can we actually do that, and are we doing that at enough pace? Because, you know, when you put money in its place, it's a means to an end. It's not an end in itself. It actually has no value in itself. And a lot of people, I don't think, so financial literacy is a big thing. A lot of people don't understand that. The application of capital is just a means of exchange. And so now we're into applying capital in good spaces to ensure we're getting outcomes that are aligned to good outcomes. And what we're finding is this whole global change of climate change, it's actually moving closer to our mighty worldview. So, you know, we're embracing this and going, well, we're now getting a voice, we're now getting seen as these values actually start to resonate a bit more. Still not easy, but yeah, I mean, that's probably start of a longer list.
Yeah. No, great. John?
Yeah, look, in our world at the moment as an investment manager, there's a ton of issues to worry about and keep us awake at night. And you know, putting the financial ones aside, sort of, you know, inflation, global debt levels, a bunch of challenges, but sort of social and environmental challenges. Firstly, I think leadership is a major challenge, and that's both at a political and corporate level. You know, trust, sort of polarization of views, not being bold enough, I think, with a lot of leadership, too much of a compliance focus in some areas. So I think, you know, mindset change. And the other thing I think is deeply concerning is just social inequity, and it's a global problem. And I think it's, as an investment manager, as someone who believes in capitalism as a great system for providing solutions, social inequity actually undermines the entire system, and that is something we need solving, and it's becoming more and more urgent, you know, as time passes, and we need boldness from our leaders to help find solutions. And when it comes to business, I don't think profit is a bad thing. I just want to see business really focus on purpose as much as profit.
Yeah. And that's obviously kind of easier for you guys as boutique investment managers, you know, where you have a particular slice of the market and a position. Are you kind of concerned about how the rest of the investment world moves? And John, I realize you've done a recent LinkedIn post kind of expressing that concern. How do you see the challenges of not just kind of your own investment function, but actually shifting the industry as a whole? Do you see that happening? What are you optimistic? What's happening? John,
yeah, look, do you mind if I take it first? I'm optimistic about the future, because I think if you look at where we've come over the last 10 years with the large providers, I think change is happening, just not fast enough. And a lot is, if you think of the large institutions, if you think of the banks, you know, a lot of their change needs to be customer driven and needs to be awareness in media. And you know, what we're particularly thinking about in our KiwiSaver at Pathfinder, we're investing in private companies that have impact. Like, you know, we've recently invested in a company called Mint Innovation, which we don't invest in mining companies, but Mint Innovation do what's called urban mining, which is taking e-waste and extracting up to 20 metals from the e-waste. And it's investing in solutions like that. And the large providers just aren't doing that. You know, we've invested in a company that does biodegradable Band-Aids. We've invested in New Zealand solar company, and the bulk of capital in KiwiSaver, which is, you know, somewhere between 90 and $100 billion. Imagine if we had 3 or 4 or 5% of that invested in private assets in New Zealand. We're talking billions of dollars of investment. And Tim and I and the other boutique managers can do so much, but we need the large providers to really mobilise capital.
Yeah. Tim?
Yeah, I mean, when our starting perspective is not too dissimilar. I mean, it's living in harmony with the environment. It is about how us and our kids and our grandkids still can thrive in a healthy environment. So now you're talking water, air, soil, and the rest of it. And of course, we capture that in Ranginui and Papatūānuku. So, I mean, the hope is that it is a soft landing, that we do transition and that the whole industry does make the shift and doesn't just keep chasing bottom line and shareholder primacy. Because if we don't, then we're in for a hard landing, which is more geopolitical upheaval and increased risk of the climate change events that we've seen recently. And it's a bit scary when you're in the space and you start looking at the certain data. I mean, I've downloaded a couple of graphs to talk about the future of forestry in Tūwharetua. We're saying, 20 years out, should we still be planting the Pinus radiata? Well, we're going to get more cyclones. And then you look at the rainfall data, you look at the seawater temperatures, you look at the ice melt, you look at the amount of fires just this year in 2023. That it's like exponential off the chart. And you try then not to get into the doomsday thinking and come back to this fact, actually humans are quite resilient, and we don't, things do not change. But you have to look back to big events, First World War, Second World War, GFC, and can we jump? How do we jump through this one?
It's actually it's a really good example, Tim, because it just shows the importance of thinking holistically, and the sort of the idea of massive pine plantations going to solve our climate change problems is fantastical thinking that isn't actually going to solve much. And I'm very well aware of the data from Canada and other places where actually some of the exotic plantations are sequestering very little carbon. In fact, in some cases, even net emitters. So we need to be looking further ahead and at more holistic solutions than that. And John, on that issue of sort of how much are the mainstream funds putting into impact investing, that's such an important issue, because most people from our surveys want to invest in something that makes them feel good. And as you know, we're sort of working with you and other fund managers on how we can help that transition so that the funds can make more of these impact investments available. From your perspective, John, you've been on this journey for a while on investing in private companies and in companies that make a positive impact. Where do you think the barriers are? What's kind of preventing others from moving in this direction as well?
Look, I think a lot of barriers can easily be identified around it's hard to value some of the companies. You need to find a deal pipeline. You need specialist skills in your team. And those are all true, but they can be overcome because we're not the only smaller KiwiSaver provider who's doing this. I think ultimately, those are barriers, but the ultimate barrier is business as usual. The ultimate barrier is that mindsets need to change and say, yeah, we've got to enhance the way we're doing things and really think about the future. I encourage executives I talk to think about what is the world, and Tim sort of talks about this better than I can, but what is the world you want in 30 years' time in Aotearoa, New Zealand? What does it look like? What does it mean for prosperity and animal exploitation and land use and planetary boundaries? And then look at your investing now and say, is that going to get me to the place I want to be? No, it's probably not. How do I need to retool things and reconfigure things to bring about that future world we want? And you mentioned impact investing helps people feel better. Yes, it helps people sleep better at night, but it also makes them money, and it also has a real world impact. And that's what I think we really need to focus on, is mobilize capital, not just for making money, but also real world impacts.
Yeah. And Tim, I realized that TAHITO Te Tai Rehua has started off with primarily or only investing in listed companies. Do you see a future for TAHITO to be developing funds in future that will also be investing in private companies, SMEs, smaller companies that have a more direct impact?
Yes. But just quickly on that last little discussion we had. I mean, I'm of the position that any tree is better than bare farmland, and that New Zealand went too extreme in the last century, and we cut down too much forest, be it native forest. So any tree to me is better than there's plenty of farmland. And I'm a governor on a large farm estate. We can still plant up another couple of 100 hectares without even impacting our farming platform. And I think that's a lot of large farms. Our issue, I'd love to get to the scale where we can get into impact. I mean, we spend a lot of time measuring impact within listed companies. I think any good company that transitions towards net zero or brings in changes, transform their business, brings in circular economy principles. They target a zero to landfill waste policy, and they measure that. They reduce their water use and tidy that up. They have been impactful in my mind, but there's without a clear definition of impact. To be able to separate those listed companies, because the biggest issue for us at our size is just the liquidity. As soon as you go into private equity and direct investments, most of our clients, and the clients behind them, they're saving for retirement, they're saving for the rainy day, they're saving for a big event. And invariably, there's going to be moments where they're going to want to take that cash out. But when you get to scale, you do get the ability to lock up, effectively for a 10-year period or 15-year or 20-year period to put into the private equity space. And so I look forward to that day. And because as John knows, you find your balance. Liquidity is only one of the many risks that you measure, but when you're smaller, it's harder. So, but look forward to the private equity space. And in New Zealand, I mean, I raised a question around the modern portfolio theory now. I think it needs to be challenged and reviewed, because if you want impact, well, which country do you want it in? Do we want our New Zealand funds to come back into New Zealand, or do we want impact in Africa or in Northern Europe? And we've got to challenge ourselves on those questions, because right now it says that 60+% of your equity investment should go offshore because of the global risk factor, and that's all changing. I think it's a moving feast. Be good to hear your view on that stuff, John and Barry.
John?
Yeah, look, I'm with Tim on that. We typically KiwiSavers are overweight investing in New Zealand, but we have an informational advantage and a skill advantage investing at home, and we can actually, our families live here. We should be focusing on improving environment here. And while climate change and ocean pollution and a whole bunch of issues don't respect national boundaries, so help solve in one country, you're having an impact around the world. But really, we can have, with the way we invest through KiwiSaver, for example, we can do a really good job of focusing on New Zealand.
Yeah, I couldn't agree more with you, Tim, that the traditional investment models of efficient markets and modern portfolio theory are broke and need fixing in today's world. I mean, we live in a world where market failures and externalities and are not captured by markets, and they need very different approaches and different ways of thinking. On New Zealand versus global, I kind of, as a former head of Oxfam, I love the idea of some New Zealand investment going into parts of the poorer parts of the Pacific, into sub-Saharan Africa and elsewhere, and making a real difference to people's lives. And I think that's a really good type of investment. But we've got a lot of things to do here, a lot of priorities in New Zealand. So certainly I'd like to see that be a priority as well. So let's wrap this up, because we deliberately keep these seminars short in order to give our audience a snapshot and leaving them wanting more. So I encourage anyone in the audience to go and visit TAHITO's website, Pathfinder's website, come on to Mindful Money, and there's lots more information for people to follow the threads that we've been talking about in this discussion. Thank you very much, Tim. Thank you very much, John. We really kind of celebrate with you these awards. I think you guys make it easy to run these awards because you put up a really strong, convincing, credible case for being award winners. So huge congratulations to both of you.
Thank you, Barry.
And acknowledge all the good work that Mindful Money does, because you're pioneering in the space as much as
thank you very much.
We are.
Cool. Thanks to both of you. And thanks to those who've joined us live and those who are listening online. I just wanted to say this series wouldn't be possible without our generous sponsors. So we're very grateful for the support of Alphinity, Medical Assurance Society, Mercer, New Zealand Green Investment Finance, with thanks also to contributions from Chapman Tripp, Booster, Harbour Asset Management and Trustees Executors, and also contributions from Pathfinder and Pi Funds. So next week we're talking to the award winners in the impact investment categories. It'll be it's Bill Murphy, who's founder and CEO of Purpose Capital, and Rowan McMahon, who's one of the co-founders and a partner in the Climate Venture Capital Fund. So that'll be a really interesting discussion, same time, same place, next Wednesday. Thank you all for joining us. Stay active, invest mindfully. Ngā mihi nui kia koutou, mā te wā.